All right, let's dive right in. Every single day, leaders and companies face the same core challenge. How do you make smart, profitable investment decisions? It's all about choosing where to put your capital to work. You get it right, you create incredible value. You get it wrong, well, you destroy it. Today, we're building the Strategist's Essential Toolkit to make sure we get it right. And we're zeroing in on two of the most powerful concepts in all of finance: present value and net present value. So let's kick things off with a classic business dilemma. You've got two options on the table. Project A gives you a $500,000 profit. Project B gives you a $600,000 profit. Now, the obvious choice seems to be Project B, right? I mean, more profit is always better. But hold on, as we're about to find out, the best financial decision isn't always the one that jumps right at you. This is exactly the kind of strategic problem we're here to solve. Okay, so to get to the right answer, we need a game plan. First, we're going to tackle the fundamental question: how do you even value the future? Then we'll unpack our first tool, present value. After that, we'll level up to a more powerful tool, net present value. Then we'll put them head to head in a showdown to really see what makes them different. And finally, we'll see how these tools drive huge, multi-million-dollar decisions in the real world through something called capital budgeting. Let's get started. So, before we can even touch any formulas or tools, we have to establish a core principle. You can think of it as a universal law of finance that underpins, well, everything. And it all comes down to one simple idea about valuing the future. Here it is. It's so simple, but it is incredibly profound. A dollar in your hand today is worth more than that same dollar a year from now. If you don't remember anything else from this, remember that. But why? Well, because a dollar you have right now can be put to work. It can be invested. It can earn interest. It has potential. A dollar that you have to wait for is just, well, it's just waiting. It's not doing anything for you yet. Now, this big idea has a formal name: the time value of money. And it's all about that phrase, potential earning capacity. That dollar you're promised next year, well, it missed out on a whole year of potentially earning a return for you in the stock market or a savings account or by funding a new business idea. This isn't just some abstract theory. It's the absolute bedrock of modern finance, and it's the engine that powers both of the tools we're about to unpack. All right, with that foundation solidly in place, let's build out our first tool, present value, or just PV. Think of this as the first layer of our analysis. It's designed to answer one very specific question: what is a future promise of cash actually worth to me right here, right now? So what exactly is present value? It's basically a calculation that acts like a time machine for money. It takes a future amount and tells you its equivalent value today. And to do this, it uses something called a discount rate. Just think of that as your required rate of return, or the interest you could have earned if you had the money today. It's like we're discounting that future value to account for the earnings you lost while you were waiting. And the beauty of this is that it all boils down to a pretty simple formula. Let's break it down real quick. PV, present value, that's what we're solving for. FV is the future value, the cash you're expecting to get. The R is that discount rate we just talked about. It's the opportunity cost of your time. And N is just the number of time periods, which is usually years. We're essentially just dividing the future money by all the growth it missed out on. Okay, let's make this real with an example. Imagine you have a choice. Someone offers you $3,200 today, or you can wait 1 year and get a guaranteed $3,500. You know you can safely invest your money at a 4% annual return. So, which is the better deal? We pull out our PV tool. Step 1, the future value is that $3,500. Step 2, our discount rate is 4%. Step 3, the time period is 1 year. We plug those into our formula, and boom, step 4 gives us the answer. The present value of that future $3,500 is actually $3,365.39. And that is the power of PV. The math tells us that getting $3,500 in the future is the same as having over $3,365 in our pocket today. So when you compare that to the other offer of just $3,200, it's clear that waiting is the smarter financial move. PV just cut right through the confusion and gave us a solid, data-driven answer. It's a fantastic tool for valuing a single future payment. But what about projects that have an upfront cost? And that very question brings us to our next tool, net present value, or NPV. Look, if PV is the foundation, then NPV is the strategic skyscraper we build on top. This is the A-list tool. It's what CFOs and strategists use to evaluate major, company-shaping investments. The key word here is net. NPV takes the PV concept one giant, crucial step further. It doesn't just look at the money you're going to get in the future. It also forces you to account for the money you have to spend today to get it. It's the present value of what you get minus the present value of what you give up. And for most projects, that's simply your initial investment. So let's run through a quick corporate example. A company's looking at a project. It needs a $10,000 investment right now. The forecast says it'll return $14,000 1 year from now, and the company's required rate of return, or discount rate, is 6%. So first, we do what we already know how to do. We calculate the present value of that future $14,000, which comes out to $13,208. Next, and this is the key step, we subtract that initial $10,000 investment, and that gives us our final NPV. The net present value is a positive $3,208. Now, this is so important. What does this number actually mean? It doesn't just mean the project is profitable. It means that after paying for the entire project and after earning your required 6% return on your money, there is an additional $3,208 of pure value created for the company, all measured in today's dollars. This chart shows it perfectly. You've got the negative bar, that's the $10,000 initial investment, the money going out the door. And then you have the positive bar, the $13,208 present value of the cash coming in. As you can see, the positive value clearly outweighs that initial cost. And the difference, that surplus value right there, that is your net present value. And this right here is the golden rule for decision making. A positive NPV is your green light. It's the signal to proceed. It means the project is expected to generate more value than it costs, all while exceeding your minimum required return. A negative NPV? That's a clear signal to hit the brakes. The project would actually destroy value. It's an incredibly powerful, clear-cut metric. All right, now that we've got both tools in our toolkit, let's put them side by side. It's time for this showdown. Because honestly, understanding when to use which tool is what separates a good analyst from a great strategist. At its absolute core, the difference is stunningly simple. PV is a one-way street. It only looks at the future cash coming in. NPV is a two-way street. It looks at the cash coming in, but it critically subtracts the cash going out. One tells you what a future amount of money is worth today. The other tells you if the journey to get that money is actually profitable. This table really lays it all out. PV gives you a value. NPV gives you a difference. PV focuses only on the inflows. NPV looks at the whole picture, inflows and outflows. And that leads to the most important difference, their purpose. PV asks a simple question: what's this future cash worth? But NPV asks the real strategist's question: will this project actually create net value for our business? And that brings us to our final and frankly most important section, the capital budgeting mandate. This is where the theory hits the road. This is where these tools are used to make the massive decisions that shape the entire future of a company. Capital budgeting is just the formal process of deciding which long-term projects to invest in. So we have to ask the critical question. When you're in the boardroom and you're deciding where to allocate millions of dollars of your shareholders' money, which tool do you reach for? Is it PV or is it NPV? When it comes time to make that final call, which one carries more weight? And look, the answer is crystal clear. NPV is the superior tool for capital budgeting, period. Why? Because it gives you the complete picture. A project could have a massive present value of future cash, but if the initial cost to get there is even bigger, it's a terrible investment. NPV is the only tool that captures that net result, that true creation of value, because it forces you to account for the cost. So let's bring our strategist toolkit together for a final recap. We started with present value, our foundational tool for pricing future cash in today's terms. Then we leveled up to net present value, our strategic tool for measuring true profitability by subtracting out the costs. This makes NPV the undisputed king of capital budgeting because it considers the full picture. And it all boils down to one simple rule. A positive NPV signals a project that creates value. And that's your green light to go. You know, we started with a simple choice between two projects. And now you can see that the highest raw profit isn't always the best investment. You have to account for the time value of money and the size of your initial investment. You now have the tools to do that. So I'll leave you with this final thought. With this new strategic lens, what future opportunities, either in your business or even in your own life, will you now reevaluate?